Hello traders and welcome back to the new video of Nova Forex. Have you been in such type of trap wherein you have marked a demand zone or a supply zone and the market disrespects it and goes into the opposite direction? Then don't worry, you would get a solution of this in this video. So, in this video we would discuss about the flip zones that the institutions and central banks usually make in order to increase liquidity into the market through which they can easily place their long or short trades into the market. Now before we move on into our video, be sure to subscribe our channel so that you never miss out any of our upcoming videos. Now let's commence the video. Let us first learn the basic concepts and then we would learn the strategy of the flip zones. The basic concepts which we need to learn are break of structure, change of character, supply and demand zones, order blocks and liquidity zones of W and M pattern. Let us learn the first concept first, which is break of structure. The break of structure occurs into the market when the market breaks its recent higher high to the upside into the bullish phase, and in the bearish phase, the market breaks its recent lower low to the downside. The break of structure indicates a trend continuation into the market. Most of the retail traders and small institutions initiate their buy or sell position on the basis of the break of structure being created either to the upside or to the downside by the market. Now let us move to the second concept, which is change of character. The bearish change of character occurs into the market when the market breaks its recent higher low to the downside in a bullish phase. And in the bearish phase, if the market breaks its recent lower high to the upside, then we can say that the market has created a bullish change of character. The change of character gives a sign of reversal into the market. The third concept which we would learn into this video is order blocks. The order blocks are refined areas of supply and demand. The smart money places their buy or sell limit orders at this order block zone. The reason behind creating an order block zone is to fulfill their pending orders into the market. Let us see an example of order blocks being created into the market. So, here we can see market doing the break of structure to the upside, which indicates that the market is in a bullish phase. And then we see market creating this imbalance candle that created inefficiency, and thus, we would plot the bullish order block zone from its previous candle. And then, let us see how the market reacts when it reaches at this bullish order block zone. The market went above after reaching at this zone, and this big bullish candles which are being formed here gives an indication of aggressiveness shown by the smart money. Every order blocks formed into the market are not always correct. Sometimes, it happens to be a trap also. Let us move to the fourth concept of this video, which is supply and demand zones. The supply and demand zones are basically the zones at which there are a lot of sell as well as buy limit orders are being set. The correct way to trade the supply and demand zones is to plot it from the higher time frame, and then we would switch over to the lower time frame for confirmation and entry, as the market has the tendency to respect the supply and demand zones more of the higher time frame rather than of the lower time frame. Now let us learn about the fifth concept, which is liquidity zone of equal highs, which is also called M pattern, and equal lows, which is also called W pattern. The basic idea behind creating the liquidity zones by the smart money is to gather counter orders which are needed in order to initiate their long or short trades easily into the market. The market mostly creates these two types of liquidity zones into the market as it helps them in gathering more counter orders into the market, as a lot of retail traders and small institutions use these analysis of equal lows and equal highs to initiate their long or short trades into the market. Now let us see some of the basics of the flip zones. Firstly, what are flip zones? The flip zones are those zones from which the market switches its direction from bullish to bearish or vice versa. Let us see an example of it. So, here we have the pound USD chart on 1 hour. We can see market doing the break of structure to the upside, which indicates that the market is currently going through a bullish phase, and thus, we would find the areas where we can initiate our buy position into the market. And then, we see market making a bullish order block zone as it made this big imbalance candle that created inefficiency into the market. Let us wait for the market to reach at this zone. So, as you can see that the market went below this zone, which hits the stop loss of those traders who have placed their buy limit orders at this zone. And then we can see price reaching at this zone, and then it continued going downwards. This is why we can call this zone as a flip zone, as this bullish order block zone became bearish order block zone. The flip zones mostly occurs during the end of a bullish or a bearish trend into the market. And sometimes, it occurs when the market makes a pause into the trend for few minutes or hours, and then it again continues its existing trend into the market. Let us see an example of it. So, here we have the Euro-Australian dollar chart on 4-hour time frame. We can see market doing the break of structure to the upside, which is why we can say that the market is going through a bullish phase. And then, we can see market going into the consolidation phase. In this consolidation phase, we can see market making equal highs pattern. This is why the retail traders and small institutions would place their sell limit order at this zone. Now let us wait for the market to reach at this resistance zone and then see how the market would react. So, as you can see here that the market went above, which hits the stop loss of the retail traders as well as small institutions. And then we see market reaching at this zone again. The market again went up after reaching at this zone, which is why we can call this zone as a flip zone, as this resistance zone became a support zone. Now that we have learned the basic concepts that are necessary to learn, let us move to the strategy through which you can easily identify and plot the flip zones correctly, which would help you in maximizing your profits into the market. So, in this strategy we would use the multi-time frame analysis in order to identify and plot the flip zones correctly into the market. Let us learn this flip zone strategy with an example. Here we have the Canadian dollar-yen chart on 4-hour time frame. We can see that the market is doing the break of structure to the upside, which is why we can say that the market is going through a bullish phase currently. And then, we see market making this demand zone as the price made this big bullish imbalance candles. Now let us wait for the market to reach at this 4-hour demand zone. We can see that the market has reached at this zone, and thus, we would switch over to the lower time frame, which is 1-hour time frame, for confirmation and entry into the market. So, here at the 1-hour time frame, we can see that the market went upwards quickly after reaching at this zone. Now you may get confused that from which candle should we draw the fair value gap zone. So, the answer to this is that we can see market making this resistance zone, and then the market broke this resistance zone to the upside. And thus, we would draw the flip zone from this resistance zone, as there are higher chances of market respecting this zone. Now let us wait for the market to make a retracement and reach at this flip zone. We would initiate our long position from this zone and keep our risk to reward ratio at 3:1. We can see market making this big bullish candles after it came to this zone, which indicates that there were a lot of buy limit orders being set at this bullish order block zone. And as you can see that the market went above after reaching at this zone, which is why we made huge profits into the market. Now let us learn the second strategy, which is supply and demand zone flip zone. In this strategy also, we would use the multi-time frame analysis like we did in the previous strategy. Here we have the Euro-New Zealand dollar chart on 4-hour time frame. We can see that the market is doing the break of structure to the downside, which indicates that the market is in a downtrend. We can see market making a supply zone here, as it made bearish imbalance candles which created inefficiency into the market. Now let us wait for the market to reach at this supply zone. Now as the price has reached at this supply zone, we would switch over to the lower time frame for confirmation and entry. We can see price disrespected this supply zone as it went above it, which indicates that there is a high bullish pressure into the market. We can see price making an imbalance candle here. And then, we see market making a small pullback here, and then it came at this zone. We would initiate our long position from this zone. We would keep our risk to reward ratio of 3:1. And as you can see that we made nice profits through this trade. This brings us to the end of this video. So, in this video we shared the best flip zone strategy that you can use in order to make good profits into the market. Now before we end this video, if you found this video informative, then don't forget to like it and make sure to subscribe our channel to never miss out any of our upcoming videos.